Happy Monday, folks. Give me a second, as always. Let me make sure that we are streaming across all the various platforms. As I was just sharing with Alex, I am on 3 hours of sleep, and I haven't eaten since Monday of last week, doing this 10-day fast. So stay tuned, because if any of you watch this, suddenly see me pass out, okay, that's actually kind of a good thing, because this means that this whole conversation can go viral. And I want to get Alex as much attention from this as possible. As we're live here, doesn't matter if you're watching this on LinkedIn, YouTube, X, I can see you in your comments. Let's make this interactive. So if you have any questions for me, for Alex Shahidi, please post on whatever platform you're on. And I'm happy to engage with you all live here with Alex. This will be an edited podcast under Lead Lag Live on all of your favorite platforms. This will be a very good conversation. I had a nice conversation with Alex last month. There's a lot going on more recently, which I think is good to kind of keep in mind in the context of the framework of what risk parity really is ultimately about. And this, by the way, folks, is a sponsored conversation by Evoke Advisors. You're going to learn more about their RPAR and UPAR ETFs, and perhaps why this might actually be a really good regime shift for them. So with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the rough hour is Mr. Alex Shahidi of Evoke Advisors. I know we've done this before, Alex, a number of times, but you know how this game works. Introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Well, thanks for having me again. It's always fun to have a conversation with you. I'm Alex Shahidi, co-CIO and managing partner of Evoke Advisors, $25 billion RIA in Los Angeles, manage money for institutions and high net worth clients. I've been in the business for 25 years and spent the first 15 years of my career at Merrill Lynch and the last 10 years on my own as an RIA. And love talking about investing, love writing, speaking about investing. So ready to go.
I don't think I've asked you this question before, but given that your focus is on the institutional side, the high net worth side, is it true that institutional clients really are long-term, or in some ways can they be as hyped up on FOMO as retail?
I think a lot of it depends on the committee. So we have to remember that institutions are made up of the people that represent the institutions. They're not living beings themselves. So some institutions are made up of an advisory committee or a finance or investment committee that has a long-term orientation, and some are not, just like individual investors. I'd say overall, they're probably a little bit more disciplined than high net worth, because typically there's an investment policy that they're bound to, and they're also, it's not their own money, it's somebody else's money. So there is a little bit more long-term focus, all else equal, but it's not that different, because they're people, and people have emotions and biases and personal experiences, which colors their investment framework.
And I think people have different definitions of risk. There's the traditional finance definition. There's career risk when it comes to chasing markets. Let's define how you think about risk when it comes to investing, given that you do a lot of content around investing, and then get into risk parity itself.
Sure. Yeah, risk is just such an interesting concept, and I'm just fascinated by it. And one of the things that I think really separates it is that we always think about return and risk. Returns you can see every day. You can see the returns show themselves every day, good or bad. Risk is something that is not always transparent. And as you just referenced, there's very different definitions of risk. So it's a much more complicated concept. And I always think of it as it's the most important thing all the time, kind of like your health. But what happens is when you go through a long enough period, and everybody has a different time horizon, when you go through a long enough stretch where bad things don't happen, then risk falls down the priority list. And it's kind of like your health. You go through a long stretch where you feel good and your health becomes a lower priority. Even though it was always priority number one, you kind of just forget about it. You become complacent and it falls down the priority list until something bad happens. And all of a sudden it's priority number one again by a long shot. And I feel risk works similarly. And in some ways it's very deceptive. It kind of falls down the priority list. But at the same time, that's when you really should be thinking about it. So I'm a little I approach it in a somewhat counterintuitive way. When we go through a long stretch where it's been all good news, I just get more nervous because I feel like there's something coming. And so it doesn't mean I invest more conservatively. I'm just more aware. So going back to your original question of what is risk, I think of it as you can think of it as three different dimensions. There's risk of loss, which I think is probably the most important. That's just a catastrophic loss. So when you're playing the investment game, your goal is to just make it to the end. And if you just benefit from compounding by staying in the game, that's how you win over the long run. Compounding is just miraculous in the returns and dollars it can generate. So just don't take a catastrophic hit where you're out of the game. So I think that's most important, is minimize the risk of catastrophic risk and try to eliminate it if possible. And you do that by just not being concentrated. It's actually relatively simple. Dimension two is the risk of a long stretch of underperformance. You could go through 5, 10, 15, 20 years of having very poor results. That's a big deal. That's really hard to make up. If you're 50 and you want to retire at 65 and your portfolio does nothing for 15 years, then when you get to that point, it's really hard to make that up. And the reason that's relevant is the stock market goes through long periods where it does poorly, and most people put all their eggs in the stock market basket. So I think that's number two. And number three, it's the traditional measure of volatility. I think that's probably the least important of the three, but that's the way most people define it, and it's because it's something that is more easily measurable. Is volatility. And obviously there's risk of, agency risk and career risk and peer risk and all those other things as well.
What's interesting about that is that volatility is the least important of the ones you mentioned, but it's the one that people react off of the most.
Yeah, that's right. And then also there's volatility can be good, right? Upside volatility is a good thing. So you want upside volatility. You don't want downside volatility. So only half of volatility is actually bad. So it is much more complicated than that. And also downside volatility creates opportunity. So it is fairly multifaceted and it's pretty complex.
The risk of ruin is always a thing that, which you correctly termed the risk of a catastrophic loss, is, I think, often underestimated by most investors. You know a lot of the history of markets. Is there something to the idea that the longer markets go up, the longer the smooth return pattern exists, the more likely you're towards some kind of a tail event, you're heading to some kind of risk of ruin type of scenario? I think the problem is people get stuck with the trend as it is now, and the trend's your friend until it ends, but typically when it ends, it's a very nasty end.
Yeah, and if you just take a step back and you just think about how markets work, so there's fundamentals that drive returns, and then there is human emotion. These are, for the most part, humans that are deciding what to buy and sell. Even the computers do a lot of things that humans do. They'll buy the things doing well and sell the things doing poorly. So if you go through a long period where the markets do really well, complacency sets in. It's natural, and so the concern about downside risk fades with time, as you would expect. And the longer you go without having a material drawdown, the more optimism is in the price, the less concern there is about downside, and that just perpetuates. And so imagine you have those who are really conservative, and the market just keeps going up and up and up. Eventually, you pull those in. They'll say, "Okay, my approach has been wrong for so long. I need to change my approach." And then you kind of get the last bear standing, and everybody's in. And that's usually the time when you start seeing the market reverse. It's not an exact science, but you could conceptually understand why that would happen. And so if you take a very high level look at it, and you just look at economies around the world, they tend to go through a Great Depression every 50, 100 years. And the longer you go without that massive, period of ruin, the less concern there is that it could repeat. And so that's basically how those cycles kind of go through time. And it's understandable why that would exist.
All right, so let's talk about the risk parity framework for the audience here. I'm a big fan of the approach. This coming from a guy who's highly tactful in his mindset. Because as much as I talk about conditions, the reality is nobody knows what tomorrow brings. So I always go back to the idea that diversification is having exposure to as many different paths as possible. All right, that's I think sort of the way, at least I like to think about it. Define for the audience what risk parity is.
I think a good synonym for risk parity is balanced portfolio. I don't love the name because it has people have a hard time understanding what it is. A balanced portfolio, I think, is more understandable. And the key is what does it mean to be balanced? And I think the way to think about it is that each asset class has a certain bias to the economic environment. And so, for example, if I told you that economic growth for the next 5 years was going to be way above what's expected, that's a tailwind for stocks. If I told you it'd be way below what's expected, that'd be a headwind for stocks. That's very clear. Predicting which way growth is going to go is really hard because you have to look at it versus what's expected. And so, if you know that stocks have that bias, you can own other asset classes that have the opposite bias, and you can do the same thing with inflation. Growth and inflation are the two major factors that influence asset classes. And it's not a risk that you're compensated to take. The risk you're compensated to take is exchanging risk-free cash for asset classes and earning the risk premium of those asset classes. So it seems very logical to diversify that growth and inflation risk, and that's essentially what risk parity is. And you can effectively do it without, over time, giving up returns versus a more concentrated portfolio because you're diversifying that risk that you're not being compensated to take. But the challenge in building that more diversified portfolio, think of it as a smoother path over time, is that when you're comparing it to the more volatile path, the less diversified portfolio, the portfolio that's more concentrated, typically in stocks, that concentrated portfolio is going to be more volatile. So it'll go through periods where it outperforms. Now is one of those periods. So it's easy to look at it and say over the shorter term is to say it's underperformed. And so that's the challenge. To me, balancing isn't challenging. The framework for figuring out how to balance is not challenging. The hard part is doing it in practice, because it goes back to your first question of your time horizon. One of the challenges of the investing world is a short time horizon is a lot longer than time horizons outside of this world. So 5 years is actually short. 10 years is you're getting closer to long period. And that's one of the big challenges. So for investors who have a long-term orientation, want to be more diversified, reduce the risk of ruin, reduce the risk of a lost decade, risk parity is a helpful framework to get there.
Why is 60/40 not balanced in your view? I mean, we're going to get into the different asset classes, right? But everyone has always seen 60/40 as the balanced portfolio, the moderate allocation portfolio. We know what happened since 2022, obviously not so balanced. But why is that not sort of the answer to a balanced framework?
It's actually very simple. So I'll give you the conceptual answer, but I'll start it with just the mathematical answer. So 60/40 portfolio, you can measure it over whatever time frame you want, long time, 100 years even. That 60/40 portfolio is 98% correlated to the stock market. And what I mean by that is basically the success or failure of that 60/40 portfolio is almost 100% dependent on whether the stock market goes through a good period or a bad period. And conceptually, it's easy to understand. So you have 60% in an asset that's very volatile, and you have 40% in an asset that is not very volatile. Obviously, 22, they were both volatile, but that doesn't happen very often. Over time, the bond market's volatility is maybe a quarter of the stock market's volatility. And so you're overweighting the volatile asset. So think of it, the impact on your total return is almost 100% dependent on how that volatile asset does. Stocks do well, 60/40 does well. Stocks do poorly, 60/40 does poorly. And the bonds just limit the upside and the downside. But the direction is almost 100% dependent on the stock market. So if you're looking at it objectively, how could something that is effectively, almost 100% correlated to a single asset class, how can that be balanced? It can't be. You're kind of violating the first rule of investing is Don't put all your eggs in one basket. That's what diversification is. And effectively, 60/40 puts all its eggs in the stock market basket. And so if you go through a long stretch where stocks do poorly, 60/40 will do poorly. That's what happened in the 2000s. The stock market underperformed cash for a decade. 1970s, same thing happened. Stocks and bonds underperformed cash for a decade. So that's not balanced. And now it's a different question of, well, how do you get more diversified? That's what we think risk parity is. But investors shouldn't be fooled into thinking 60/40 is balanced because it's not.
Right, and the transmission mechanism there is credit risks, default risk. Beta is the equivalent of credit spread movement. Narrowing in the bond market is correlated to beta going, positively in the direction of equities. Let's talk through this slide here as far as 60/40 against risk parity and some of these sort of major crises.
Sure. So one of the risks of 60/40, as I mentioned, it's almost all the risk is in the stock market, is when stocks do poorly, 60/40 does poorly. And this chart shows you 4 periods in the last since 2000 where economic growth collapsed. And that's bad for stocks. So we already know that. So there was a 2000 dot-com crash that lasted almost 3 years. The 2008 global financial crisis maybe lasted 18 months. The Eurozone crisis, 6 months. And the global pandemic, the pandemic lasted a while, but the downturn was about 3 months. One thing that I think is interesting as an observation is you'll notice the time period is shorter every one of these rounds. And it's because the Fed stepped in sooner. So in 2002, it took them 3 years to step in and say, okay, we got to do something. And then they just kept speeding it up. Now that's going to end at some point because you just can't, so that's a different podcast. But what's clear is when you get that downturn, stock market falls a lot in these periods from peak to trough. It was 20 to 50%. The bond market went up during those periods. These are cumulative returns. And you'll notice the Barclays Ag didn't go up very much. So the downside significantly overweighted the upside of the bonds because they're not very volatile. So if you look at the risk parity asset classes, equities, commodities, gold, treasuries, tips, what you'll notice is equities and commodities went down a lot during those periods. As you would expect, those assets do better when growth surprises to the upside and poorly when it goes the other way. The other assets are good downside growth assets, meaning when growth falls, those assets are in a bull market. I've heard this idea of, okay, when you have an economic downturn, correlations go to 1, everything loses. I think people are looking at the wrong asset classes. These asset classes are biased to do well when growth falls. And so in those periods, they went up. So think of it, if you just diversify it across all those all the time without trying to guess when that economic downturn is going to come, you can see if you just equally, just to keep the math simple, equally diversified across all of them, all those periods you did fine. Cumulatively, you were down just a little bit, and it's because you diversify that economic growth risk. Inflation is a different conversation, but in terms of economic growth, that's a very good hedge against that. And these are hedges that don't cost you money; they have a positive expected return.
All right. So with a risk parity approach, you've got these various asset classes, and you're trying to normalize the volatility across them by weighting them in different ways and using leverage to achieve that weighting equivalent. I actually don't think I've ever asked you this question, but what look-back period are you using to determine the volatility of the asset classes to figure out how to normalize them? Right? Because as we've seen with long-duration treasuries, volatility changed quite a bit, right, since the Fed's hiking cycle.
Yeah. So first off, I just want to explain why you need to do this. So if you go back to that 60/40 example, so you have 2 assets. You have risky stocks and you have low risk bonds, and you're overweighting the risky asset. So it has a material impact on the returns of the total portfolio. So if you're building a more diversified portfolio, think of it as 2 steps. The first step is pick diverse asset classes that go up and down in different economic environments. And then we showed you the asset classes that we would include in that. And the second step is you want them to have similar risk contribution, meaning the impact to the total portfolio, you want them to be comparable. That's how you get the diversification. So the assets that are more risky, you own less of, and the assets that are less risky, you own more of, so that the impact is similar across all the assets. So so how do you do this in practice, which goes to answering your question. So first off, you want to look at the volatility of all these assets and determine just mathematically which ones are more volatile and which ones are less volatile. And then what numbers do you actually use, which is your specific question. So our thought is predicting future volatility is not easy. Looking at historical volatility is easy. So you can look at bonds and say, oh, the volatility has been high recently. But did you know they were going to be high before they were high? Because your allocation isn't based on historical volatility or historical returns or historical anything. It's based on what happens in the future. So volatility is really hard to predict. And you have to be careful, because if you're trying to predict what future volatility is and you're using recent volatility as a measure, oftentimes what happens is periods of high volatility end up with low volatility and vice versa. So you can get whipsawed if you're using short-term measures. So the answer to your question is we use as long a period as we can use. So it's usually 40 or 50 years volatility, which we know is kind of average volatility. You'll go through periods where it's higher, periods where it's lower. It's hard to predict that in advance, is our experience. And so we just use 40 or 50 year measures. And just very simply, stocks, it's about 15% volatility. Commodities, about 15%. These are commodity producer stocks, and gold as a basket. And then long dated tips, long dated treasuries, about 11% volatility. And they'll fluctuate. And on average, they'll probably end up about there. And so the ones that are less volatile, we own more of. And the ones that are more volatile, we own less of. And that gets you to that risk parity structure.
I want to assume that long duration treasuries have the most deviation against their historical average volatility. How do other asset classes look, in the most recent past against their own longer term respective gyrations?
Yeah, I think the volatility is kind of higher across the board.
Yeah.
And I haven't looked at the data this closely, but my guess is the 1970s wasn't that different. So in that period, the way to think about it is that what drives the volatility is shifts in the economic environment and also shifts in monetary policy. So, when you go through a period like the 80s and 90s, where inflation started to come down and inflation wasn't as big of a deal after the 70s, when it was like the most important thing. And like the 2000s and the 2020s, inflation was kind of steady. So that the volatility there wasn't high, and it was basically growth moving up and down. And so those inputs resulted in generally less volatility than normal. But in the 70s, the volatility was much higher. And if you could go back to the 30s and 40s, volatility was a lot higher. So I think the reference point most people use is kind of that perfect environment where inflation was coming down, growth was relatively stable. There was some bad periods, but relatively stable. Monetary policy was always putting its was providing stimulus anytime there was a sniff of an economic downturn, and you kind of had this Goldilocks environment, and so volatility was probably lower, and it spiked recently, but I don't think it's unusual if you widen your aperture and you just look at all of history.
I wanted you to talk about when cash is king. So I'm going to share this slide here, also from your deck, because I think this is instructive. So much of our business is, at least from a fund perspective, is about where you launch in the cycle. If you come out of the gate and you have a strategy, whether it's risk parity or another strategy, and the cycle is in its favor in the first 3 years, as you know, you get a ton of assets, people pay attention, you're suddenly a top performing fund manager, everybody wants to talk to you. If you happen to launch an approach into a cycle, and a cycle can last some time, to your point, 3, 4, 5 years is relatively short, but feels like forever. It becomes really hard because people don't quite understand what cycles are as they're living in it day to day. We happen to be in a cycle, maybe up until recently, whereby it was really all about cash as the play. So talk about risk parity in different periods where cash was king.
Yeah, I think this is something that is pretty broadly misunderstood. So the way to think about cash versus assets. So think of it as you're an investor and you have one big decision. You could take zero risk, own cash, and get whatever the yield is. So I think the yield is average 4% a year over 100 years. For over a decade, it was zero. And recently it jumped a lot in 22, so now it's a little bit less than 5%. So you can just get whatever that yield is, take no risk. Or you could take risk. And one way to take risk is to just own asset classes passively. And so these asset classes should earn a premium above cash. The stock market is maybe 5 or 6% a year above cash over 100 years. And it makes sense because if that wasn't the case, people wouldn't give up the risk-free return. So the idea here is you can own cash or buy risky asset classes. So the decision one is, do I want to take risk? Decision two, when you buy risky asset classes, is do you want to have high diversification or be concentrated? And most people, maybe not realizing it, are very concentrated. They're basically betting on the stock market. Or you can be more diversified across multiple asset classes and have a more of a risk parity framework. And you can structure that in a way where the return is equity-like. So you don't really have to give up returns. It's a very simple framework. You're basically collecting risk premium in a more diversified way. So you'll take less risk to get the same return, or same risk and get a higher return over time. Now, what you have to understand when you diversify, what you're diversifying growth and inflation surprises, which is the main thing that impacts markets over time. But the thing you can't really diversify against is environments that you reference when cash is king. And it goes back to what I said earlier. You can hold cash, get whatever the return is, or you can take risk and go into risky asset classes. And so when cash all of a sudden becomes king and it's the most attractive asset class, then diversifying across a bunch of risky asset classes doesn't help you because cash is king. And it doesn't happen very often. It usually doesn't last very long. So on this chart, we're showing a 40-year period where you had 5 cases where cash was king. And it's over, some are longer, some are shorter. Doesn't happen often. And usually after cash stops being king, you get a reversal. And so the most relevant to what we just experienced in 23 was 1980 to 82, when Paul Volcker stepped in and said, okay, enough of this inflation thing. We got to kill inflation, hiked interest rates to similar magnitude as what we just experienced, and killed inflation. And that was bad for all asset classes at the same time, because, so think of it as stocks earn 5% above cash. If cash is zero, long-term return for a 5% for stocks is attractive. If cash all of a sudden goes to 5, who's going to buy stocks that are priced to earn 5 when you can get 5 from cash? So stocks have to reprice to give you a forward-looking return of, let's say, 10. And the only way you can do that when cash moves that quickly is for the price of that asset to fall. So in some ways, it's mechanical. So you can see on this page, basically, whenever you had a period where cash was king, all assets fell in tandem. And then when that period ended, all assets rallied together. Usually you get some sort of policy response, either an easing or, the other type of environment where cash is king is when you have pure panic. So there was like a 1-month period in global financial crisis, not the whole period, but a short period. And then also there was a 2-week period during COVID when people just freak out. They don't care about anything. They just want to own cash. Usually that is very short and very rare. And usually it's followed by a massive policy response, which results in a rebound the other way. So I think you have to understand growth and inflation are diversifiable risks. Most choose not to diversify that. Risk parity does. But what you're left with is environments when cash is king. And if you happen to start your strategy right before cash is king, you're going to face that headwind. It's mechanical. It's understandable. It doesn't happen very often. It doesn't persist. And then when it ends, you're in a better place. So like if you just think long term, let's say we're sitting here today and, stocks should earn 5% because cash is zero. If cash goes to 5, stocks should earn 10 going forward. They'll reprice, but then going forward, you're in a better place than if cash stayed at zero the whole time. So it's important to understand these cause effect linkages so you don't overreact to just the headline returns. Sometimes what happens is you overreact, you sell low, and then markets recover, and then you look at it and say, oh, it looks good now, I want to buy. And it's kind of like the second violation of uh, kind of, if you go back to the beginning of investing, don't put all your eggs in one basket. Rule number one. The second rule that many people violate is you're supposed to buy low and sell high, and many people buy high and they sell low. So understanding the mechanics of how markets work and asset classes price is really important to avoid those mistakes.
Has the king abdicated his throne? I mean, your personal opinion on this cash is king dynamic, is the cycle now over for that? Because a lot of people are saying, I think there's some legitimate concern around this idea that you have another wave of inflation coming. The Fed's going to have to hike rates further and do an about face. What's your own personal thought on that?
Yeah, it's very possible. It's hard to know. The example I always use is the Fed hike rates 500 basis points in a short period of time. If you ask them, if you pull them into this room, and a couple months before that hiking cycle started, and you polled the people actually moving the interest rates and said, "Are you going to raise rates 5% in the next 12 months?" I don't think anybody in that room would have said, "Yes, that's our plan." So it surprised the people actually moving the rates. So anybody who thinks they can predict these things, I think, is fooling themselves, because the people actually moving the rates didn't know themselves. So I don't know. I mean, I think the odds are low. For rates to go from 0 to 5 and then from 5 to 10, that seems like a lot. But it's certainly possible. But what you have to consider is it kind of goes back to the three forces: cash is king, shifts in inflation and growth. Shifts in inflation, shifts in growth. And if you think about what would cause rates to move up a lot, it's probably inflation picks up, as you just alluded to. And so what you don't want is you have a portfolio that has no inflation hedges in it, so that you don't benefit from that side of the surprise, and then you only get hurt by the policy response of moving rates up a lot. The other consideration, which is a little bit more technical, but I think it's worth mentioning, is that in the 1970s, the Fed raised rates a lot, but it didn't happen in a short period of time. I think rates started 5 or 6% in the beginning of 1970 and finished the decade in the mid-teens. So that's a significant interest rate hike. But what happened was rates went up and inflation went up, and so real rates actually fell over the decade, while nominal rates went up about double digits. So if you were invested in TIPS, which didn't exist at the time, you actually would have had a tailwind because real rates fell, but nominal bonds, treasuries, did really poorly. They underperformed cash for a decade. And so you can have diversification even in a period where the Fed is hiking. And a lot of it depends on the pace at which that hiking occurs, and then also what happens to growth and inflation at the same time.
I think this whole real yield dynamic is an interesting one to kind of push a little bit further. I'm showing a slide here on why TIPS underperformed in 2022 through 2023 during that time period, because I think a lot of people did think that it's Treasury inflation protected securities, right? That that was the security of choice, and it turned out it was a lot more complicated.
Yeah, I mean, but it's not a surprise.
Right.
So TIPS, by the way, they outperform treasuries. So if you look at the period where inflation was a problem, TIPS outperformed treasuries all through that period. And if you think about it, as an investor, you want to own some bonds to protect you against economic downturns. And you can think of it as there's two flavors. There's TIPS and there's treasuries. They're both the same security. One gives you inflation protection and the other does not. And so when you go through periods where inflation surprises the upside, TIPS should do better than treasuries and vice versa. And that's exactly what happened. So we say TIPS underperformed, but in some ways they outperform. They outperform the alternative to TIPS, which is treasuries. So they actually held up reasonably well relative, but we say underperform because they went down. And a lot of people think, okay, inflation went up, TIPS went down, they don't work, it's a terrible asset class. And the misunderstanding there is the yield went up a lot. You're getting paid inflation, so they were yielding it was like a high yield bond that had no credit risk, no inflation risk. And so the yield went up a lot, but the price went down because real yields rose massively. But what happens is that none of that is a surprise. We don't know that's going to, the cause effect is exactly as you would expect. You didn't know real rates are going to go from, negative to +2 in a short period of time, which is a pretty significant tightening. So that part of it makes sense. Mechanically, it makes sense, the returns. But if you look at it today, the real yield is the highest it's been in a very long time. And you can get CPI plus 2% guaranteed. Some institutions might have a CPI plus 3 target, and many have a CPI plus 5. If you can get CPI plus 2 guaranteed by just buying a tip, that's a pretty good start. Yet very few portfolios own tips. And if you think about what the market is discounting inflation to be going forward, it's a little above 2%. So if you feel like inflation there's asymmetry, that there's more risk, that it surprises to the upside, you should probably overweight tips versus nominal bonds. And very few investors actually do that.
Yeah, and I think very few investors do that in general, just because there's this this narrative out there, which is partially justified, that there's so much government debt, U.S. Treasuries are trash. Doesn't matter if it's tips or nominal. And the definition of CPI changes, so who knows if tips are really accurate when it comes to even giving you real return. And I think that makes it challenging, right, to sort of argue that that's a good diversifier when you have this almost like frustration around government spending, which should really not have that much to do with the actual longer term performance of treasuries, because the U.S. government's got a printing press.
Yeah, and I think a lot of those comments are fair, but how they relate to tips and treasury pricing, I think, is not as well understood. I feel like those concerns have a lot to do with, or a lot more to do with, the currency than it does the safety of tips and treasuries. As you mentioned, if you're a borrower and you have the ability to print money, you're probably not going to default on your debts. And so you kind of go back to 2011 when treasury rating was downgraded, and they rallied massively. And it's because what happened was you had an economic downturn, and the Fed cut rates, and treasury prices went up a lot. That's the cause effect linkage you would expect. And so I think what matters a lot more to the price is how the economy transpires. And if you get an economic downturn, the market is going to expect the Fed to cut rates. Short-term rates fall, long-term rates typically fall, and treasuries rally. And the longer duration you have, the more it goes up. And tips, it's impacted by real yields, which is a little bit more nuanced, but it's probably in many ways even safer because you have that inflation protection in place. As I mentioned, in the 1970s, real rates actually fell. So tips had a tailwind while the treasuries had a massive headwind. And you could easily see the same thing happen again. So it's more, to me, it's all those concerns of money printing and bad fiscal management and all those other things. I feel like it's more of a currency question and concern, in which case you can diversify that. You can own things like gold. You can own, if you want, Bitcoin. You can own non-US securities. And that's another level of diversification. But I think of it as, if you're trying to protect against an economic downturn, which is one of the biggest risks for equities, which is the main risk in portfolios, I don't know if there's a much better option than tips and treasuries. They're probably not perfect, but it seems like one of the better options. And until something better comes along, that's where I would focus.
Let's talk about how you go about leveraging in RPAR, and then we're going to talk about your UPAR ETF as well. Because as yields are rising when cash is king, that's also what the margin cost of leverage comes from, whereas as a baseline. How does RPAR and UPAR, which again we'll talk about shortly, how do they leverage, and how is the cost of leverage factored into performance?
Yeah, I think this is another area that there's a lot of misunderstanding. So I'm going to try to simplify it. So you could have a risk parity portfolio that has no leverage. And the way to think about it is, if you just go back to the 4 major asset classes: equities, commodities, which includes commodity equities and gold. So that's 2. Long dated treasuries, long dated tips. So you have 4 diverse asset classes. The treasuries and tips are less volatile than equities and commodities. So you own more of those, and you own less of the equities and commodities. And now you have a risk parity portfolio. So we're not even introducing leverage yet. That's just, you have 100% to allocate, and you allocate it so you're risk balanced. So think of that as the starting point. of a more balanced portfolio than one that is equity concentrated. Now, you can take that balanced portfolio and you can lever the whole portfolio. And the way to think about that is, and you can do it, by the way, with the cost of financing of cash. And the way you do that is by using futures in areas where you can use futures. And the cost of futures is the implied financing cost, which is effectively cash. So you have a balanced portfolio to start with no leverage. You can lever that balanced portfolio to different degrees. If you lever it about 20%, that's what RPAR is. So think of it as a 20% levered risk parity portfolio is RPAR. And what you're doing there is you're taking a balanced portfolio that has some expected return and you're levering it, and the cost of financing is cash. And so as long as you expect a balanced mix of asset classes to beat cash over time, then RPAR should outperform an unlevered RPAR because your cost of financing is cash. And if you just think about what it means when the cost of financing goes up or down, it doesn't really impact the returns. If anything, it helps the returns. So think of equities as cash plus 5 to keep it simple. When cash is 0, equities return 5. When cash goes to 5, then equity should return 10. So if your cost of financing is cash, the premium above that shouldn't change whether financing costs or cash are low or they're high. But the total return goes up when they're high because it's not all levered. So an unlevered RPAR portfolio has a lower return when cash is low and has a higher return when cash is high. And a levered portfolio, same thing. The expected return goes up when cash is higher and it goes down when cash is lower. And the cost of financing goes up as well, but the total return rises. And then UPAR is even more levered than RPAR. So it's basically 40% more levered than RPAR. And so if you think that RPAR will beat cash, then UPAR should beat RPAR because it's levered 40% more. So it's just different ways of getting a very well diversified portfolio at different levels of risk and return.
And I'm showing a slide here that looks at the allocations that pretty much summarizes that. It's interesting, right? Because I would think that from a very long-term perspective, you probably want UPAR over RPAR.
Yeah, there's a catch though, and the catch is you have to be able to hold on.
Right.
So think of so you see two pie charts on this page. If you draw a pie chart on the left, that's unlevered. Okay, so that you can think of it as 60-40 expected returns in that ballpark with less risk. RPAR is an equity-like return with 60-40 type risk, and UPAR is equity-like risk with an expected return that is going to be above equities. So think of it, UPAR as equity-like volatility, but it's more diversified than equities. So its risk of ruin is going to be a lot lower. Its risk of a decade of underperformance is a lot lower, but its volatility will be comparable. And so you have to be able to hold on. And the challenge is that for many investors, it's probably easier to hold on to stocks than it is UPAR, even though they have similar volatility, because stocks are more familiar, whereas UPAR is less familiar. So if they're not zigging and zagging together, then people are going to look at UPAR, the reference point is stocks, and they'll say, this isn't working, quote unquote, it's not working, and I'm out. Whereas with stocks, you understand it's not working. It is working. Your friends are invested in stocks. Stocks are in the papers, on TV, and it's understandable. You all kind of go up and down together, so you're in the same boat. UPAR is more diversified. It doesn't zig and zag with the stock market by design, so it's harder to hold on to. So if you have a long enough time horizon, you understand it, then it is a more efficient way to get returns than stocks because it's just more diversified.
It seems to me that RPAR, or maybe even UPAR, if you're a more aggressive type of investor, can be an entire portfolio. Right? It's basically a framework because it's got so many other asset classes beneath its surface. Not investment advice or recommendations, but when you talk to financial advisors, you talk to institutional investors, do they think the same, that it's like, well, this should just be the entire portfolio, or is this more of a satellite to 60-40, which again, this should be a better diversifier too?
Yeah, I think of it more as a tool. So at kind of the most complex level, I think you're right. you could think of it as a total portfolio, but I don't know if that's very practical. So the way I think about it is as a tool, and I think of there's a spectrum. On one end of the spectrum, you have 60-40, basically what most people do. On the other end of the spectrum, you have RPAR/UPAR, where it's a super diversified portfolio. And by the way, we're only talking about public markets, long only, passive. You're just looking for a framework. So you have the spectrum, less diversified, 60-40, but more conventional. And then on the other end of the spectrum, the two extremes, much more diversified, but less conventional. And so I think of RPAR and UPAR as tools in order for clients to move along the spectrum towards being more diversified. And by the way, you're not giving up returns by being more diversified over time. It's kind of like the free lunch in investing, more diversification. But you can't go all the way because it's hard to live through the periods of relative underperformance. And so think of those as tools to take a step towards more diversification. So very simplistically, you could start with a 60-40 portfolio. And if you want to take a step towards being more diversified, you could put 5 or 10% in RPAR or UPAR out of the 60-40. And now you've taken one step towards being more diversified. At an extreme, you convert the entire 60-40 to 100% RPAR or UPAR. That's probably too much for most people because you have to be able to live through it. And so for each investor, each advisor can determine this if they're looking for their investors, or each individual investor can do it for themselves. They can figure out how much can I handle. I know more diversification is better, but it's not practical to go all the way. So maybe we'll go one step. We'll see how it goes. Maybe we'll go another step later. And just think of RPAR and UPAR as tools to help you get there efficiently.
Good question off of X, which you can kind of riff off of. What's the most tax efficient way to implement the leverage version, which is UPAR?
Well, one of the beautiful things about these ETFs is that they're single ETFs. So the tax efficiency of ETFs, I feel like it's one of the most untapped technological innovations in finance. So when you look at ETFs out there, most of them are either stock ETFs or bond ETFs, and there's a few commodity ETFs. There are very few fully diversified ETFs. And one of the advantages of wrapping a lot of asset classes inside of a single ETF vehicle, even though when you look at the label, it looks like it's less diversified because it's a single line item. But if you take the cover off, it is super diversified. RPAR and UPAR have 13,000 plus securities inside of them. But inside of a single wrapper, you get the benefits of being able to rebalance, which is this repeated process of buy low, sell high that most people have a hard time doing in practice. And one of the reasons you have a hard time doing it is because when you sell high, you have to pay capital gains. When you wrap it inside of an ETF, a lot of that can be shielded, if not all of it. It's kind of the innovation of ETFs. And so one of the reasons we took all these asset classes, wrapped it inside a single vehicle, is to give you those tax efficiencies. So when I talked about RPAR and UPAR being tools to get you more diversified, they're also tools to help you become more tax efficient. Because so simple example, you have 60-40, 60% stocks, 40% bonds. If you want to rebalance because stocks have done better, you have to sell the stocks and there's a capital gain, and you got to buy the bonds. If you have a portion of that 60-40 inside of RPAR or UPAR, so let's say you take 5% from stocks, 5% from bonds, and you put it inside of the RPAR UPAR wrapper, the rebalancing within that happens automatically. And for the most part, you can avoid capital gains by rebalancing within the ETF. So you've taken a portion of your less tax efficient 60-40 portfolio, put it inside of a much more tax efficient ETF wrapper. And that helps you become more tax efficient the more you move in that more diversified direction.
Alex, for those who want to track more of your work or learn more about RPAR, UPAR, where would you point them to?
Our website, rparetf.com, has a lot of information. We're always trying to post educational material. We do a quarterly webcast, quarterly market, or quarterly RPAR review. So that's on there. The recorded version's on there. And then on our advisory site, evokeadvisors.com, feel free to look on the website. We post a lot of educational material there as well. I also have a podcast called The Insightful Investor that comes out weekly. And these things take a lot of time, but it's definitely worth it. I've learned so much. So that there's a lot. That's not just risk parity. It's a lot of investment topics. Risk. I don't even know if we've talked about risk parity on there, but we cover just about everything. So they can tune into that as well.
I'm still jealous that you got Grantham for that. That was a big one. Everybody, please make sure you learn more about RPAR and UPAR. Again, this conversation is sponsored by Evoke Advisors. Great conversation with Alex Shahidi. Make sure you do everything you can to have a longer term mindset because at the end of the day, FOMO has a funny way of being ruinous. So, with all that said, appreciate those that watch this. Again, this will be an edited podcast under Lead Lag Live, and we'll see you on the next episode.